Wabtec completely crushed consensus for Q2 2026. I mean, we are talking a massive beat across the board. Revenue came in at a staggering $3.18 billion, and that is up 17.5% year over year.
Right, which is just a huge top-line number for them.
Exactly. And GAAP EPS sits at $2.33, while their adjusted EPS hit $2.76, so that's a jump of nearly 22%. Management didn't even hesitate. They immediately raised their full-year guidance, projecting revenues between $12.3 and $12.6 billion, with adjusted EPS bumped up to that $10.69 range.
And, I mean, the market reaction to those numbers tells a very clear story. The stock moved immediately. For anyone analyzing the industrial space right now, seeing a legacy heavy machinery company put up these kinds of growth metrics, it's a massive signal about the current state of capital expenditure.
It really is. So today's deep dive is going straight into the source material from Wabtec's Q2 earnings report and presentation. We're going to look under the hood to see how a 155-year-old rail and transit Goliath is achieving double-digit growth in what is, frankly, a pretty tough macroeconomic environment.
Yeah, because the headline revenue and earnings are fantastic, obviously, but if you really want to understand the long-term health of a capital-intensive manufacturing business, you have to look straight at the cash generation.
Right, because earnings can be massaged, but cash is cash.
Exactly. And Wabtec reported $441 million in operating cash flow just for this quarter.
Wow.
Yeah, which translates to an 82% operating cash flow conversion rate.
Okay, wait, let's pause on that for you listening at home. Because in the software world, conversion rates are usually about, getting clicks or converting trial users. But in heavy manufacturing, what does an 82% operating cash flow conversion rate actually mean on the ground?
Well, it basically means they are incredibly efficient at turning their paper profits into liquid reality. Net income on an income statement, it includes all sorts of non-cash accounting adjustments.
Depreciation, things like that.
Right. Exactly. But in heavy industry, you are buying literal tons of steel. You're running massive global factories and carrying huge inventory. If your cash gets trapped in unsold inventory or uncollected receivables, your business chokes. It doesn't matter what the EPS says.
So an 82% conversion rate means the money is actually clearing the bank.
It means 82 cents of every single dollar of net income is available as pure liquid cash. They can use that to pay down debt or fund new acquisitions or, return capital to shareholders.
Which is huge for their flexibility.
Absolutely. That specific cash efficiency is the structural foundation that gave management the security to raise their full year 2026 guidance. Like you said earlier, you can massage earnings, but you really can't fake cash flow.
So to understand how they are generating that kind of liquidity, we have to look at their primary engine, right, which is the freight segment.
Right, the absolute core of the business.
Yeah, and that segment alone brought in $2.24 billion in sales, which is up 16.9% year over year. But diving into the segment breakdown, it reveals a pretty stark divergence.
It does.
Because equipment sales surged by 35%, driven heavily by these massive new locomotive deliveries. But on the flip side, their services revenue actively dropped by 4.2% due to lower modernization deliveries.
And management did note that the service drop was expected, but, it creates a really complex revenue dynamic when your legacy cash cow, which is servicing existing fleets, is temporarily shrinking while your new builds are accelerating.
Well, and that dynamic is exactly why the next number just totally jumps off the page. Because the most shocking metric in the entire freight segment isn't the equipment or the services.
No, it's the digital side.
Right. Digital sales skyrocketed by 88.5%. Now, I have to challenge narrative forming around this a bit.
Okay, let's hear it.
Because, you're pointing to an 88% jump in digital sales, but let's be realistic here. This company just pulled in $2.24 billion bending metal. Are we overhyping a tech transformation just because the percentage growth of some tiny software division looks impressive on a slide deck?
I get that pushback. I really do. It is very tempting to write it off as just a small base effect, but you have to analyze how that digital layer completely fundamentally alters their core business model.
Oh, so?
Well, they aren't trying to pivot away from heavy metal. They're weaponizing digital to lock in the metal. This 88.5% explosion, it isn't just organic growth from legacy software.
Right, they bought their way in.
Exactly. It's fueled by highly targeted recent acquisitions, specifically inspection technologies and Frauscher sensor technologies.
So they're essentially buying their way into the industrial Internet of Things.
And they are buying incredibly specialized capabilities, like Frauscher, for example. They develop advanced wheel sensors and axle counters. Wabtec isn't trying to build consumer apps here. They are acquiring the digital nervous system for the global rail network and embedding it directly into their physical infrastructure.
Okay, I see where this is going. If you buy a traditional locomotive, it's basically a one-and-done transaction for the manufacturer, right, until something breaks.
Exactly.
But if you weave proprietary sensor tech into the axles and the tracks, you're essentially creating the Apple iOS for freight trains.
That's a great way to look at it.
Yeah, the hardware just becomes the vessel for a deeply integrated software ecosystem.
And that is the exact mechanism driving their multi-year backlog. When you embed digital technology, predictive maintenance software and real-time inspection tech into multi-million-dollar locomotive fleets, you change the entire nature of the customer relationship.
Because you lock them in.
Exactly. You lock in service agreements for years. You aren't just a vendor anymore. You are an operational partner.
Let's actually look at those backlog numbers because they totally validate this strategy. The 12-month backlog in the freight segment is up 10.2%, and that's excluding currency impacts.
Which is solid on its own.
Very solid. But the multi-year backlog, so the orders stretching out into the late 2020s and beyond, that jumped by an astonishing 47.8%.
And revenue visibility like that is the holy grail for a heavy manufacturer. I mean, when a company is just selling discrete replacement parts, they basically start every single quarter relatively blind.
Right, they have a hunt for sales.
Yeah, but a 47.8% jump in the multi-year backlog means Wabtec has essentially secured its revenue pipeline against short-term macroeconomic shocks. By embedding digital infrastructure into physical rail networks, they make their products incredibly sticky.
And prohibitively expensive for customers to rip out and replace with a competitor's system later on.
Exactly. The switching costs become massive.
So the freight strategy is brilliant, right? Moving massive cargo while capturing all the diagnostic data. But freight is just moving boxes.
Right.
Does this hardware plus software strategy actually work in the passenger and municipal transit space, where you are dealing with government budgets and passenger safety?
Well, the transit segment numbers suggest they've cracked that code as well. The transit segment is, often treated as the less glamorous sibling to freight, but its performance in this report is stellar.
Yeah, they pulled in $936 million in sales, which is an 18.9% increase. And the earnings presentation specifically highlights the recent Dellner Couplers acquisition alongside really strong original equipment and aftermarket sales.
Which is a huge win for them.
It is, but integrating a major physical hardware company like Dellner Couplers into an existing global supply chain, that usually wrecks a company's margins in the short term.
It historically does, yeah. Integration requires significant capital. You are paying advisory fees, you have redundant IT systems to merge, factory footprints to consolidate.
Layoffs, restructuring.
Exactly. Significant severance or restructuring costs. You fully expect the balance sheet to bleed a little during that process.
Which makes the profitability metric here completely counterintuitive. Because despite those heavy acquisition and integration costs, the transit segment's adjusted operating margin actually expanded by 250 basis points.
It's wild.
They hit 17.7%. How do you expand your operating margin by 2.5 full percentage points while simultaneously swallowing a massive new acquisition?
You can really only pull that off if the underlying organic engine of the business is running at peak efficiency. Like, the earnings report notes that even on a constant currency basis, transit sales were up 17.7%.
So that strips out any FX noise?
Right. It strips out any benefit from favorable foreign exchange rates, and it strips out the superficial addition of the acquired revenue. It basically means their core business, just selling and servicing transit systems, is absolutely booming.
So the base revenue is growing so aggressively that it just easily absorbs the fixed costs of integrating Dellner.
Exactly. When your organic sales volume scales up that rapidly, your fixed overhead costs are spread across a much larger revenue base. The margin expansion basically proves they are scaling up efficiently, not just, buying top-line revenue at the expense of profitability.
Okay, so we have booming freight equipment, exploding digital sales, locking in multi-year contracts, and a transit segment that is expanding margins while absorbing acquisitions.
That's pretty good.
It does. But no industrial giant operates in a vacuum, and the fine print in this earnings report details some very real friction points on the tracks.
Oh, absolutely. The macroeconomic environment for heavy industry right now is incredibly hostile.
Yeah, the report explicitly lists a whole gauntlet of headwinds. They cite increased tariffs, unfavorable raw material costs, and an unfavorable product mix within the freight segment.
And that's just the external stuff.
Right, because on top of that, their SG&A, so their selling, general, and administrative expenses, along with engineering expenses, have gone up, mainly driven by the overhead from these recent acquisitions.
And look, those are not theoretical risks for a retail investor to ignore. Tariffs and raw material inflation are direct, immediate attacks on your gross profit line. When the cost of steel goes up or a border tax is applied to imported components, your manufacturing costs spike instantly.
So here's my challenge on the math then. With tariffs and raw material costs actively eating into profits and overhead expenses rising, how is Wabtec actually managing to expand its overall consolidated adjusted operating margin to 21.9%?
It doesn't seem to make sense, right?
No. If your input costs are going up across the board, your margins should be shrinking, not expanding.
Well, the math works because of aggressive internal countermeasures. The report references a structural program they call Integration 3.0.
Okay, Integration 3.0 sounds like a corporate buzzword for, like, a software update. What does that actually look like on a factory floor?
Fair question. In heavy manufacturing, Integration 3.0 is a brutal, ongoing process of continuous cost improvement and portfolio optimization.
So cutting the fat.
Exactly. It means they are constantly analyzing their global manufacturing footprint to eliminate redundancies. If you acquire 3 companies that all make, say, a slightly different version of a brake valve, Integration 3.0 means you standardize that part across all locomotive models so you aren't managing 50 different suppliers.
Ah,
I see. Right, and it means using the very predictive software they sell to their customers internally to cut down the time their own factory lines sit idle.
so they are squeezing inefficiencies out of the supply chain to lower the baseline cost of manufacturing.
Yes. The productivity gains from Integration 3.0 are acting as a massive shock absorber. Raw material costs push expenses up, but extreme factory optimization pulls the manufacturing costs down, which neutralizes the impact.
Okay, I buy the factory optimization argument for raw materials, but what about the tariffs?
What do you mean?
Well, you can't just lean manufacturing your way out of a government tax imposed at the border. That is a hard fixed cost.
No, you can't optimize a tariff away. That is where their pricing power and their contract structure come into play. The report highlights that they are offsetting these macroeconomic headwinds through cost recovery via contract escalation.
Contract escalation. Walk us through the actual mechanics of how that protects them.
So Wabtec builds mission-critical, highly specialized infrastructure, right? There are very few companies on Earth capable of delivering a custom fleet of diesel-electric locomotives or a city's mass transit control system.
True, it's a very small club.
Because they operate in a near oligopoly, they have immense leverage when negotiating long-term contracts.
So they dictate the terms.
Pretty much. They include escalation clauses built directly into the legal framework of the deal. If you sign a 5-year contract for rail equipment, the contract explicitly states that if, say, global steel prices spike 15% or a new government tariff adds a 10% tax on components, Wabtec is legally allowed to adjust the final invoice proportionally.
Oh, wow. So the macroeconomic shock is contractually passed straight on to the customer.
Exactly. The customer absorbs the blow because, honestly, they have nowhere else to go for the equipment.
That is incredible pricing power.
It is. Combine that structural pricing power with the favorable profit mix coming from their newly acquired higher-margin digital sensor businesses, and they are able to entirely insulate their margins from those headwinds.
So that's how they do it.
Yeah, expanding a consolidated operating margin to 21.9% while actively absorbing tariffs and raw material inflation, it just demonstrates ruthless, disciplined management execution.
It really does. Stepping back from the specific margins and acquisitions, though, Wabtec's report provides a crucial macro signal for you listening today. Because when you look at their consolidated 12-month backlog, it sits at $9.14 billion.
That's a massive number.
And their multi-year backlog is up 41.7% overall.
Right. And you do not build a multi-year backlog approaching $10 billion unless the physical industrial economy is experiencing sustained heavy demand.
Exactly. Municipalities and global logistics companies, they do not commit billions of dollars to future infrastructure and multi-year fleet renewals if their internal models are predicting a massive global recession.
No, they would pull back immediately.
Right. That backlog is a concrete vote of confidence in the physical supply chain.
It proves the physical economy is highly robust. But just as importantly, the 88.5% surge in Wabtec's digital sales proves that the integration of digital sensors, predictive software, and data analytics into heavy industry, it's no longer a futuristic concept.
It's here right now.
It is a reality that is driving massive high-margin revenue today. The digitization of the physical world is accelerating at an unprecedented pace.
It makes you wonder about the long-term shift in the global economy, doesn't it?
Hmm.
We spend so much time assuming the future of technology will always be dictated by the software startups coming out of Silicon Valley.
Right, the traditional tech bros.
Exactly. But here is a 155-year-old company achieving its highest growth by acquiring digital sensor tech and weaving it into thousands of tons of heavy metal.
It's a total paradigm shift.
It is. As the world becomes increasingly reliant on physical logistics and supply chains, you have to wonder, maybe the most dominant and profitable tech titans of the 2030s won't be born in a garage. They might emerge from legacy rail yards that successfully digitize the physical world.
That is definitely something to keep an eye on for any portfolio.
Absolutely. Well, that wraps our look at Wabtec. Be sure you follow the show for daily earnings coverage so you never miss out on these market-moving reports.